there. It is not. मिर्ची खाती करती मिर्ची खाली आपल्याला हे तू जाणीस One hits the glass. Pinocchio sir. First sequence to them and then when I tell them, I told them at 1:30 that I'll take a class at 2:30. 2:36 will be in the class. They're all touch-ups. Good afternoon, everyone.
Good afternoon, sir.
Good afternoon, sir.
I think there are 10. Yeah, we can start. Yeah, so basically, I, there has been one major issue is I plan for a class and for some other calculate, all calculations are going to happen on this figure, that is 10. So if a company declares a dividend of say 5%, 5% of what? 5% of 10% is how much? 5% of 10 rupees is how much? 5% of 10 rupees is how much? It's 0.50 paisa. It's 50 paisa. Please understand. Okay. Dividends are never calculated on the market price of the share. Dividends are always calculated on the face value of the share. So this is the one important point that we have to understand as far as equity valuation is concerned. The second point that we have to understand as far as equity calculation is concerned or equity valuation is concerned is that many a times it might so happen that you purchase the share today. Okay, you purchase the share today and you want to keep the share for a considerable period of time. Let us say you want to keep the share with you for 5 years because you expect that the share is going to give you a good amount of return. That's the reason you want to keep the share with you for 5 years. But in these 5 years, it might so happen that the share might go up, it might come down, again it might go up, it might come here, it may rise again, it may fall. All these things are possible. So if you observe this movement, if you observe this deviation that is happening, that is going to affect your returns. That is going to affect your returns. So in this particular case, okay, we cannot use the traditional formula that was given to us in the third unit. Now, what was the formula to given to us in third unit? We calculated total return from the share is equal to dividend plus ending price of the share minus beginning price of the share, the whole divided by beginning price of the share. This was the formula that we had learned in unit number 3 as far as total return. This formula holds good when you are holding the share. This formula holds good when you are holding the share only for 1 year. This formula is useful to calculate total return only when you are holding the share for 1 year. But if you are holding the share for greater than 1 year, if you are holding the share for greater than 1 year, this formula is not going to be of any use to you. This formula is of no use to you. You have to go for a different formula. So in such case, whenever you are holding a particular share for greater than 1 year, we have to use a concept called as multiple year holding period. So we have to use a concept called as multiple year holding period formula. Using this particular formula, we are going to estimate what could be the potential return on that particular share, or in other words, how much return can be generated by holding the share up to that particular price. Clear? Now, please understand one thing. Remember, at the start of this particular unit, I had told you two things. One is bonds are always bonds are always traded on their. Can anyone tell me? Bonds are always traded on their price or yield. Bonds are always traded on their yield. Okay, whereas shares are always traded on their price. When you want to trade in the shares, what do you look? Do you look for how much dividend that particular share gives, or how much, what is the present price level of that particular share? What do you check whenever you are trading in a stock market? Do you check how much dividend is expected from that particular share, or what is the present price level of that particular share? What do you decide? You look at the price, right? That is the reason whenever we are calculating or whenever we are doing valuation of the share, we always arrive at the price of the share. Whenever we do valuation of the share, we always arrive at the price of the share. And whenever we do valuation on the bond, we always trade bonds on yield, or we do the valuation based on the yield. Clear? So these two concepts are completely different from each other, and that is the reason when stock market goes up, bond market always falls down. And the reverse is, when the stock market falls is falling down, bond markets always go up. There is an inverse relationship. Okay, there is a inverse relationship between these two. Please try to understand this. Clear? So in the whatever we discussed as far as bond is concerned, we our main concept is we wanted to get a good yield on that particular bond. But whenever we are discussing about shares, we are not concerned about how much dividend that the company is going to pay us. We are more concerned about what is the present price level that I have to pay to get that particular share, and how much the price is expected to go up. So the difference between the price that I buy today and the price that I'm going to sell tomorrow, that is going to be my profit. That is the reason shares are always traded on price, whereas bonds are always traded on their yield. Clear? Now, coming to where we started, we are talking about if we hold the share for more than 1 year, we have to use a concept called as multiple year holding period formula. Okay. Now, what is multiple year holding period formula? I'm just putting it here. Please go through this and note it down, because this formula is very important. Please note down this particular formula. Whenever we are going to hold the share for more than 1 year, we have to use this particular formula, that is multiple year holding period concept. Please go through this particular formula once. Okay, and if you're not able to understand, please let me know. I can explain to you. Okay, what I'm going to do right now is I'm going to close this particular slide, and I'm going to open the PDF file that I had circulated you, the PDF file wherein there were problems related to multiple year holding period. I'm going to open that particular PDF. So if you have it in your mobile, please open it. If you don't have it, you can look at the screen itself. Clear? Just give me a minute. Yeah, can you see the screen? Can you see the problems here?
Yes, sir.
Yeah. Just look at the formula first. Look at the formula, and then we'll discuss about the problems. Note down the formula, note down what are the notations. Okay, and immediately you have a problem. There is nothing much to explain here. We directly start with the problems, and once we solve the problem, then we'll be able to understand what we are talking about. Okay, just go through this. First, go through it, go through the formula, and remember, you have to write the formula. You cannot by heart that particular formula. It will come to you by practice. Gone through it?
Yes, sir.
Yeah. After going through this, please understand the notations. What do you mean by the word letter G? What do you mean by E naught? What do you mean by D by E? All these things. These are the notations for that formula. Please note the notations also, or go through the notations also. And once you are done with that, there's a problem here. There's a problem here. Please go through this particular formula. I will explain you this formula plus I'll explain you the problem also and how step by step you have to go through it. Or have you gone through it?
Yes, sir. Yesterday we gone through it, sir. But some doubts are there, sir.
Okay, fine. I'll clarify all those doubts.
Yes.
Okay, quickly go. I hope you have gone through this particular problem. We'll come to the solution part of it. Now, always whenever you are solving any problem as far as equity valuation is concerned, first make it a point to read the formula. Okay, first make it a point to read the formula and write down the formula. And once you write down the formula, pick up what are the notations. What is E naught in this? What is D by E? What is G? Please mention all those things. If you don't mention it, later becomes very difficult for you to put those values in place. Okay, so here there is a firm. Okay, uh, the research study has stated that the return of ABC company due to capital appreciation and dividend after making adjustments for the outflow of income is 16%. What is it? Indirectly, it is given to us that this is the growth because understand the words. Okay, the company's stated rate of return for ABC is due to capital appreciation and dividend. So after the share has gone up, after it has paid dividend, after all adjustments have been made, with all this, the return is around 16.27. So in other words, return means your growth, right? So indirectly, growth or G value is given to us. So I'll write here the G value as 16.27. Okay. Uh, the recent dividend paid by the company is 40%. Clear? So here dividend payout has to be estimated. Clear? Fine. And EPS is 35 and 48. So here EPS is given to us, and here PE ratio is also given to us. Now what you need to do, you have to substitute the values here, but before you substitute, you have to calculate dividend payout ratio. I hope all of you know what is dividend payout ratio. I hope you know what is dividend payout ratio, all of you.
So that fraction of amount paid to its stakeholders in dividends, like part of earnings. Hello, sir.
Hello, sir, you are not audible.
Sir's mic is muted, Narayan.
Yeah, am I audible?
Yes, sir. Yes, sir.
Fine. So here, if you observe, we have to calculate the dividend payout ratio. Dividend per share is given to us in the problem. Just look at this. Okay, dividend per share is given to us. Yeah. The recent dividend paid by the company is 40%. 40% of what? Again, I'm coming back to the same point. 40% of what? Can anyone tell me what is 40% of? My answer is come as 4. My answer has come as 4. 40% of what will be 4? I told you the face value of the share will always be equal to face value of the share will always be equal to 1. Sorry, face value of the share will always be equal to 10 rupees, right? I'll just show it to you here. So face value of the share, just a minute. Please pay attention. Face value of the share will always be 10. Okay. So what is 40% of 10? 40% of 10 rupees? What is 40% of 10 rupees?
4.
Just- So 40% of 10 rupees is 4 rupees, right? That is where I get the dividend from. Right? So this is my dividend. How did I get dividend per share? It is whatever is the dividend payout ratio, that is dividend percentage that has been declared here. into the face value of the share, that is rupees 4. And how many earnings are available to the shareholders? It is 35. So 4 divided by 35, that means 11.43% is my dividend payout ratio. Clear? Next, required rate of return that is mentioned in the problem is 20%. Okay, holding period is I have to hold the share for minimum 4 years. I think somewhere it is mentioned here. Yeah. I want to hold the stock for next 4 years, so which is greater than 1. So in that case, naturally I have to employ multiple year holding period formula. Clear? So once I start using the multiple year holding period formula, the first step is I have to solve this part. Now what is this part? It is this particular part. Can you observe? Can you see this? So I'm just solving one part of the main bracket. So I'm just solving E naught D by E. So what is my E naught? E naught is nothing but my, what do you mean by E naught? Earnings per share. So which is 35 into dividend payout ratio. Okay, into dividend payout ratio, that is 11 by 43 divided by 100. If you want the answer in percentage, you have to divide it by 100, is equal to 4. So this entire block is equal to 4. Clear? Then using this value as 4, I substitute all the values here and get the answer. Now I'll just keep the slide open to you for 5 minutes. Just go through this particular part and then we'll see what is the next part to be done. Just go through this. Please go through this. If you're not able to follow, then let me know. Yeah, any doubts here, please?
No, sir.
Sir,
Yes, yes.
excuse me. Sir, holding period is 4 years. Then we need to calculate the 4 times, right? Like first year, second year, third year, and fourth year.
Yes.
Okay, sir.
This is
Thank
the
you.
this is for the first year, second year, third year, fourth year.
Okay, sir. Okay, okay.
It is summation, right?
Yes, sir. Yes.
So you have to add this, and when you add it, the final answer that you get is 14.79.
90. Yes, sir.
This is called the present value of dividends. This is all present value of the dividends. You will receive dividend in the first year, you will receive dividend in the second year, third year, fourth year, fifth year. So this is nothing but, this particular bracket is nothing but finding out the present value of dividends. And this value is finding out the present value of capital appreciation.
Okay, sir.
In other words, this is your current return, this is your capital return. When you add both the things, you get total return. That's it. Have you gone through it? I'm running out of time. Now, there's one small correction here. It says n plus 1. So what is your n? N is 4 plus 1, 5. And there is no change in the denominator, by the way. It is only n. So just make a note of this. Otherwise, you will blindly take it as 5 and then the entire problem goes for a toss. That should not happen. You have less than a minute or so. I think, no, I have 2 minutes. Have you gone through it?
Yes, sir.
Yes, sir. So in the next step, when we can do by doing the table, sir, or we have to do like this only.
What happened?
In the table format also we can do, no, sir. That's step
As
2.
long as the answer comes correct, Rohin, you can do anything.
Yes, sir. Yes, sir.
Don't worry. You can use tables. You can use this particular method. I am using or sticking to this particular method because the formula is given and it is easy to remember according to the formula. That is the reason I stick to this method. If you want to use a table method, you can do ahead. No problem.
Yes, sir. Yes, yes.
Sir, this type of problem comes for 10 marks.
Yes. Not this type. This also comes. This comes for 10 marks. Two-stage model. And then you have three-stage. I have not seen a three-stage model problem coming anytime, but two-stage model and multiple year holding period formulas, they do come.
Even that bond valuation problems, no, sir.
Yeah, bond valuation problems also. See, understand. One problem on calculating regression, 10 marks. One problem on calculation of duration, 10 marks. One problem on equity valuation, 10 marks. Okay, one problem on portfolio management, 10 marks. One problem on mutual fund calculations and mutual fund performance evaluation, 10 marks. One problem on technical analysis and computation of RSI, 10 marks. And one problem optional, which is fundamental analysis, 10 marks. So you have 8 questions. Out of 8, you have to write any 5, right? So all main questions, subsection 3, wherever 10 marks is mentioned, all will be problems only.
Sir, even in 3 marks and 7 marks, they in sometimes they have asked problem only, sir. In 7 marks, sir.
The reason is, if you open your syllabus clearly says 30% theory, or sorry, 40% theory, 60% problems. So you can expect problems from this particular module. Clear? Okay, I think I have less than a minute. I have to stop it. But please go through this. Tomorrow I'll discuss this again, once again. Okay, we have to complete this because I have lagging behind in the investment management. I have to complete fundamental and technical analysis, which is going to be very huge. Okay, and I need all your support because it's a assignment based unit. Okay, so we'll talk about